Okay, we're going to go to our keynote speaker of the night. I am excited to talk about this self-storage place. I'm going to throw a big number out. This speaker, since 2012, has done $780 million in self-storage transactions. Wow. Is that a big number?
Yes.
All right, good. Founded the Oklahoma Self-Storage Board and currently serves on the board. Been on the board of a host of other organizations in the commercial and self-storage spaces between here and Tulsa. Actually drove all the way here from Tulsa just to do us a favor and come speak to you people tonight. Round of applause for that, please. Very humble man. I had to pull his teeth and twist his arm just to get him to tell me anything I could do to introduce him. But very impressive, really great track record. So please welcome my friend Jared up here. We're going to learn about self-storage.
Thank you, Dakota. I appreciate the great introduction and the warm reception for someone from Tulsa. All right. Got my clicker, got my mic. You know, a day like today, coming off last week's weather, I kind of wish I was in the car wash business. Raise of hands, who got their car washed in the last week? We're convicted. We're convicted. All right. As you could have said, my name is Jared Jones. I'm out of Tulsa. I'm with a group called Argus Self-Storage Advisors. It's based out of Denver, Colorado. I'm going to dive in a little bit, tell you a little bit about me, a little bit about Argus, and then we're going to get into the meat of kind of the self-storage industry and kind of what we're seeing. Marty and I met at the Oklahoma Self-Storage Association show back in November. And so we've been doing that for about 15 years, that market update. And, I guess I did a decent enough job. He felt like I was worthy to come, impart some knowledge to you folks. So we will kind of dive in here. So Argus Self-Storage Advisors, founded in 1994. One of the interesting things is they own the domain selfstorage.com. Wish I would have bought that. It's worth probably about $15 million now, wow, that domain. So, sometimes lightning does strike. So there are about 40 affiliates nationwide like me. And whenever I tell people about Argus, it's kind of hard to explain, do you work for them or are they your brokerage company? So the easiest way for me to explain it is like this. Argus in self-storage brokerage is Chick-fil-A, and I'm the Chick-fil-A franchisee for Oklahoma. Head nods. I figured that would work. It usually works. All right, so we've done over $6 billion in transactions, 2,000 deals since 1994. We also have a third-party management platform called Argus Professional Storage Management. Manages over 250 facilities east of the Mississippi predominantly, and also have managed for publicly traded companies. So we have a lot of good optics into not only the brokerage transaction side, but also the nuances of operating these assets. And a lot of our affiliates are also storage owners. So I can guarantee you I'm a much better broker and advisor by being an owner than I would be otherwise, because there are some nuances, to different asset classes, and there's an operational component, to that real estate. And so to go to talk to a little bit about me, been very blessed since 2012. It's been a good run in storage brokerage, and so my experience is, on the brokerage side, and also as a principal, being a developer and co-syndicator, and kind of how I found my way to self-storage is I got into the real estate business in 2007 after I got out of school. And 2007 was great. 2008, I doubled my income. Oil was $155 a barrel. Any hands up? Remember those days? Everybody was making money in Oklahoma. It was great. And in 2009, my income dropped by 75%. So I made it through. And at that point in time, I felt like I wasn't unemployed only because I had some place to go. I wasn't making any money at that time, and I found the self-storage industry and started the association, and so that's kind of been my calling for almost about the last 15, 16 years. So I've sat in your seat, as an investor, and I'll give you a little bit of my background as on the principal side. So at the top 3 slides, that was part of a 4-property syndication. I co-syndicated and developed, and then also asset managed. And so we developed 2 properties out of 4 properties, about 250,000 square feet. The middle property was part man caves, and we expanded the self-storage and repositioned that property, and also added some retail. And at that point in time, we were wrapping those projects up in 2021, and things were getting extremely expensive at that point in time. There was a bubble that was going, and cheap money. And so we found a group that was very interested in those assets. They were growing dramatically, and they purchased them from us, and it was really one of the best decisions we made, was selling at the top of the market. And so it's better to be lucky than good in that instance. The 2 bottom projects I recently wrapped up in 2024. The storage facility, I bought an old bookstore, kind of an interesting project that had 2 stories in it. And then we took out both floors, took the sole out, except for 3 walls and the roof and the columns. We added 3 columns back into it, and then added on to the building. And then I threw out a line to Starbucks, and they said, yeah, sounds great. And so I was able to wrestle with that grizzly bear and get that thing built. And so now those projects are kind of clicking along. And so it's been a good ride on the principal side as well. And happy to help answer any questions as we kind of get to the end of the presentation. And I'll tell you a little bit about what we're going to talk about today, or this evening. We're going to talk about market fundamentals that we look at and kind of where things are in the marketplace. We're going to kind of talk about capital markets, because a lot of people that are in the storage business feel like they're in the storage business, but they're actually in the real estate business. And so the capital markets drive so many things regarding like pricing of assets and cost of capital and what you can pay for assets, and cap rates and things like that. We're going to talk about the performance of storage assets, valuations, how we come to what valuations are, how we underwrite them. We're going to talk about development, which has been a little bit tough these days. Prime is at 7.5%. That's typically your borrowing cost for a construction loan. And then we're going to talk about where we are in the real estate cycle at this point in time. So let's dive in. Is there a potential boom on the horizon? You read the news. I think that if nobody isn't optimistic in the first quarter of each year, you probably need professional help. I mean, we have to be optimistic, right? Especially coming off of an election year. We got a real estate guy in the White House. It's feeling good. It's feeling good. So, I mean, are we on the way up? Some think so. We'll see. Let's look at some data. So this goes back the last 2 years. It's produced by a company called Yardi. What they do is they scrub the rental rates off of websites to be able to generate this data. And these are for properties that are stabilized, basically fully occupied at 36 months after your certificate of occupancy or completion, right? So these aren't lease-up data points. These are you're fully established. Technically, you should be leased up, and this is where the macro rental rates are, kind of nationally. And it's not looking pretty, right? It's kind of on a downhill trajectory, but there's a silver lining, right? It's kind of leveling out at the bottom. And we know that in cycles, Typically, it levels out and then it goes back up. So there is some optimism due to the decline being less so than it's been in the past, right? So we got to find the silver lining, where we can, and that's kind of where the silver lining is on rental rates. Let's go look at another leading indicator, right? I think some of the most valuable real estate in our world is the front page on Google, right? And what people are searching for. So we feel like that's kind of a leading indicator for demand. And you can see from 2019 to 24, this chart's got a little age on it, kind of where the demand was. Look at 2021, that was off the charts. June, which is typically the busy season, over 95 is where that index was. I looked at the index yesterday, and we're sitting somewhere around 60. So somewhere around right there. So we're kind of around that 2022, 2020 era. What COVID did to self-storage was basically like an injection of adrenaline. It just, everything just worked at that point in time. So kind of where we're at from a macro perspective is we're getting back to kind of the pre-COVID bump is kind of where things are trending. One thing that we also learned, through going through COVID is that there's a high correlation between residential home sales and self-storage operational performance. And whenever home sales jumped off the chart, we were just absolutely killing it. And mobility is such an integral part of our business in driving people to use storage that's kind of been lacking the last 2 years. And so there is some optimism that maybe interest rates are going to change a little bit, maybe things are going to happen to be able to improve the housing market, and that's something that operators are hopeful about, that are going to give them a good leasing season, which typically begins in April and ends in August. Let's look at occupancies. All right, so these are occupancies. The public companies are actually reporting this week. So we're going to have updated data that's going to be coming out. And this tracks all the way from 2021 to 2024. I mean, look at these numbers. 95% occupied, 97% occupied. And we're just slaying it, absolutely killing it. And now, we're in the 90s. NSA, they own a big portfolio here in Oklahoma City called Secure Care. I just sold them 13 properties last August. They're about 86%. Public storage, they're around 93%. Argus Professional Management, they're around 83%. Typically a stabilized property, one that's been open 3 years, should be in that 88 to 92% range is typically what that occupancy should land at. Now let's look at some of the same store performance. And we track revenue, we track net operating income, or NOI, and then we track occupancy. As you've seen, Q3, year over year, flat or negative. Argus actually did really well. We were positive. So that's kind of how it's been the last couple of years. Since the housing market has been on ice, it's really impacted things performance-wise, where we're not able to get the velocity of rentals, and we're also a little bit soft on revenue and not getting the rate increases that we've typically been able to get. And then also, the operators have been slammed with taxes and insurance increases and actually labor costs as well. Anybody, show of hands, been slammed with property taxes, property insurance over the last few years? I went back and looked at insurance since 2020, and annualized, it's been going up between 18 to 22%. It is incredible, insurance costs due to inflation, higher cost of labor, higher cost of materials. It's just compressing margins, even more. And also, it's kind of funny, the tax man's getting smarter too. So at our storage show that Marty went to last November, the Tulsa County assessor, and we had the show in Oklahoma City, sent 2 of their guys down there to learn more about mini storage. So I've got my valuation notices so far, and their market value went up about 60%. My market value went up 160%. Has the real estate market gone up 160% from last year to this year?
No.
Well, I'll be paying them a visit whenever they send me the letter back from my protest. But that's becoming a thing. The other thing that's interesting is the county assessors are getting more sophisticated software to be able to track market values. And so that taxable value is always increasing until it bumps up against that market value. And even on Oklahoma County, it's even tracking your building permit amount on your county assessor page, which that's the first I've seen that. So it's becoming a bigger and bigger deal staying on top of those property taxes. All right, market fundamentals. We gotta have customers, right? I mean, we need renters, just like residential people need renters. Check this out. I love this slide. The percentage of U.S. households using storage is up to about 11% now.
Wow.
Up from 9% 15 years ago. You know, back in 2020, 2019, there was this very, very famous Asian lady who had this hit show. Her name was Marie Kondo. And she's talking about simplifying your life and throwing away all the stuff. I was scared. I was like, I'm going to have to get the car washes because I need people who hold on to their stuff to get my units. So, but that didn't happen, right? It's continuing to go up. Self-storage is becoming more commonplace. More people have an experience renting a storage facility. They're able to get by with maybe less square footage in their home because they have a place to put their extra stuff. So it's becoming a more accepted part of just how we live, So this is through Storable. They're one of the biggest software operators in the industry, have really good data. So March 2024 to August 2024. Are you planning or considering a move? Well, the yeses are going up, the maybes are going up, but these people, who want to buy houses or upsize or downside, they're kind of held hostage, right? They got the golden handcuffs with a 3% mortgage. Who has a 3% mortgage? I do. Am I going anywhere? No. And it's just basically we're kind of treading water until the housing market loosens up a little bit and we're affected like you guys are. I mean, I'd love to see you guys buying houses, flipping it, creating mobility, creating storage renters for us. It's great. We work well together. We just need to get a little bit of momentum. We'll help everybody out. This is kind of an interesting slide right here. Younger generations. So millennials, Gen Z, Gen X, they're 56% of the population, right? And so proportionately speaking, they should use 56% of the storage, but they actually use 79%. Pretty interesting, right? So the younger generations see the value in using storage, and they actually visit it more than the older generations. One could be due to they're a little bit more mobile and they can move stuff a little bit better, but they're actually using it well. So very positive, for our industry, that storage, which has predominantly been more of an American asset class, because you don't go to Europe and see storage facilities everywhere, at least I haven't, that I think that bodes well for the long-term future of the asset class. So let's look at storage demand. Everybody kind of eventually gets married, buys a home, forms a household. Those are stories right there. And due to these life events that are happening, combining households, I know whenever I got married, I had a 1,200 square foot house. My wife had a 1,700 square foot house. We moved in together, and I could, bring my clothes, and that was it. So we had to use storage. So I think that situation is probably very similar. And then you have a child. You got to do something with that bedroom, that gaming room you have. It's got to go away. You got to get a crib in there, but you got to put your stuff somewhere. So it's part of these life transitions. And self-storage is there to help with that. So why aren't people buying houses? So this is a cool chart from the Federal Reserve from Atlanta. 100, which is the affordability threshold, and this goes back 20 years, right? Right now, that threshold is 66. It's never been that low in 20 years. So that's one of the reasons why housing is just having such a tough time. It's just a lot of people are priced out. And also, you look at 20 years, the blue is affordable. I mean, maybe 50% of the time, housing has been affordable. I mean, that's pretty startling. Now, how does that play in Oklahoma? Oklahoma City, it's good to live here, right? We're at 87. So we just need it to improve a little bit for housing to get better and to make it more affordable. But predominantly, it's a very affordable place to live from a housing perspective. Tulsa, it's a little softer, but still, we'll take 80, versus 60. So it's good to be in Oklahoma. All right, let's talk about capital markets or financing, which has been like a bouncing ball really the last couple of years. So in my business, kind of the benchmark where loans are priced, it's off of what's called the 10-year treasury, right? So everybody hears about, interest rates are going down, things are going to improve. Well, that's actually the short end of the curve. I'm on the longer end of the curve, where I'm more impacted by the 5-year treasury, the 10-year treasury. So, when the market was starting to get adjusted in 2022, right? The banks will say the 10-year treasury is at 3%. We are going to give you a loan for 200 basis points, or 2% over that, which would be 5%, right? Well, banks started getting a little jammed up with the amount of capital they had to lend at low rates. And so therefore that spread went from 200 basis points or 2% to 3.5% or 4%, right? And so your borrowing cost went from, we'll say, 5% to 7% really quickly. And then they wanted a deposit relationship as well, a substantial one. So basically you were hoping to kind of self-fund your own loan. So let's look at the 10-year treasury yield. On the left, that's over the last 12 months, what it's done. It's moved from, started the year at 4.2, it went to 4.7. In September, it was at 3.65. We thought, man, 3.65, the party is back on. Well, you can see what happened since September. It's back up to 4.5%. So commercial loans right now, if you're going to go get a commercial loan, non-residential, you would probably be in the 7.5% range at a 3% above 4.5% 10-year treasury, if you could get them to fix it that long. And a lot of banks now are only going to lay money out for maybe 3 years because they've seen how volatile that has been, and they don't want to guess wrong. Okay? So we are tied to treasuries in the price of capital. And the price of capital helps to determine the pricing of assets, right? Because you have to borrow at X from the bank, you have to borrow at Y from your investors or yourself, and then you can pay Z, Okay, that's kind of how that works. We have a cost of capital that we have to contend with. Well, the right chart is from this group called Chatham Financial, and they do projections of all kinds of treasury yields. Does it look like those treasuries are going to go down or remain flat? They're going up, or they're staying flat. So whenever people talk about interest rates going down, right, it's the short end of the curve. This is the longer end of the curve. There's nothing that says they're going down. It just says they're going to stay maybe flat if you're lucky, and this moves a lot, or it may go up. So in a way, this is a reason for me to be a big cheerleader for Doge, because then our country won't be over leveraged, people will buy our treasuries, and therefore we may not have to pay as much interest on those treasuries. Does that make sense? All right, love this chart. This shows the relationship between the 10-year treasury, which is in green, the cap rates, which are in blue, and then the spread between the two, basically they're just subtracted, in orange. So, man, it would have been great to buy a lot of storage back in 2004, wouldn't it? You're buying at a cap rate of around 9%, and then if you would have sold it in 2021, you're selling it for 5%, you get all that rent appreciation, you wouldn't be here, you'd be sitting on the beach somewhere. And then the spread to me is interesting. So values haven't really gone up, right? We can agree on that. Yes, sir. 5.
15 minutes.
15 minutes.
Just giving you
Okay, thanks. So that spread is lower than it's been, except for 2023 in the last 20 years. So relatively speaking, storage is still very expensive, right? And it became very popular after the recession because you can see the cap rates going, well into the 6s coming out of the recession in 2009, all the way to or sub 6 to 2022. Current mortgage rates. So, as I said, spreads typically 3%. So, if you borrowed from like CMBS, which is commercial mortgage-backed securities, maybe you can borrow in the mid 6s. Otherwise, you're probably going to be around 7.5. So, risk. Commercial real estate only makes up 24% of all bank debt. And within that, 24% multifamily is the lion's share. I'm not seeing a lot of distress. In my career, which is almost 20 years, I've only sold 3 storage properties that have been REO or foreclosures. And they were all bad operators, absentee owners, and they just kind of ran them into the ground. So, there's been some talk of foreclosures. It's just not scalable. It's going to be on like a case-by-case basis, and it's going to be difficult to kind of find those assets. So performance and valuation. This is how the REITs fared over the last roughly 8 years. As you can see, 2020 to 2021, that's a hockey stick. Same store growth. Can you imagine growing your rent 25% every year? That's crazy. Well, then we corrected, which is kind of where we're at now, coming up off the bottom. Implied cap rates. So the REITs, they publicly report quarterly, and they do have net operating income. So you take net operating income and you divide it by their market capitalization, you get these implied cap rates on what the stock is. You look at national storage affiliates, you could buy a 6.5% cap rate deal, take the risk yourself, or you could just throw it in the stock market, and you get a pretty good yield there. So it's good to be sober-minded whenever you look at your investment and kind of compare it to what alternative uses of money are, whether it's treasuries or stock. So this is Oklahoma. Extra space is in green. I mean, they killed it. Q3 2021 to Q3 2022 grew their rent by 42%. It's incredible. And then it went down to flat. So basically, we have so much growth, during COVID. It's still good, but it's not what it was. And there were a lot of people that saw this and well, I got to get on the storage train. And it brought a lot of syndicators and people that raised private capital, into the market. And a lot of them right now, they have really tough basis. I did a VOV on somebody's property not too long ago. They bought it for 32 million, and it's worth 24. They're trying to sell it. I don't think they're going to be able to get it done. This is revenue growth, Oklahoma, and occupancy growth. As you see, occupancy, higher watermark of 96, 97%. Now it's in the high 80s. Look at that pop in 2021 and 2022, the sales activity, cheap capital. You saw the charts. It was a hockey stick in performance. And now we're getting back to kind of normal. Look at 2023. It tracks with 2018 to 2020. We're just reverting back to the mean. Oklahoma transaction volume. We had some really good years, in 2021, 2022, and just kind of tapered off. So last year, Oklahoma did about 125 million. I sold 75 of it. It was good. It was good. Thank you. My wife is happy. All right. Well, this is underwriting. So this year, we're kind of flat, projecting forward, flat rent to maybe negative 2 to 3%. Typically, these things sell on now trailing because people aren't as optimistic, and looking at high revenue growth in year one due to soft fundamentals. Stabilized occupancies, still 88 to 92%. A lease-up deal, those are tough now. When you build new, it takes you 3 to 4 years to get stabilized. It probably takes you at least 3 years before you're out of the red. These things are cash-eating dogs. If you can make it through, it's phenomenal. But you got to have some capital to get through. It's rough. Operating expenses, real estate taxes. It's one of the biggest line items now. Expense growth, 2.5 to 3%. Operating expenses, a lot of that is due to scale. If you had a small facility that has like 100 units, you're going to have a very high operating expense ratio. You get down to 30% whenever you have like 60 to 80,000 rentable square feet. That's whenever your scale works a little bit better. Loan to value, we've seen people get jammed up on loan proceeds, where proceeds in the past, they might be at 72%, now they're like 60. So I had one deal, we went from the first buyer to the third buyer to get it finally traded, and it just became financing issues. Now it's a matter of, if you have a deal that you're selling, it's under contract, when is it going to retrade? Not, is it going to retrade? Because you've seen what the 10-year treasury is doing, and every day a borrower knows where their debt is being priced. So it's just causing some troubles. Typical amortization, 20 to 25 years, unless you go CMBS, then you can get 30. Development wave. Typically we need to add about 500 facilities nationwide to keep pace with population growth, functional obsolescence. Does anybody know what that big fancy term means? It means your property is no longer useful, basically. Or highway departments take properties, things like that. So we had a big development wave from 2018 to 2020, just adding and adding and adding facilities. And it's finally starting to taper down a little bit, which in the long run will help the industry, because it'll help some of those properties that have been open for a while that haven't been able to lease up to get lease up, and we'll be better for it. Oklahoma, people are still building here. Oklahoma City, I know a bunch of people that are building, boat and RV. You guys probably see them go up all the time. I hope everybody can get full at good rates. We are tapering off a little bit. Probably need to taper off a little bit more based upon some of the rent numbers I'm seeing. A lot of times it doesn't make sense unless you can get $15 a square foot in rent, which you're only getting in select markets right now. All right, the real estate cycle. This is a graph that professor in Denver's put out for a long time. 2021, who was feeling euphoric? I was feeling euphoric. I mean, it was phenomenal. 2023, anxiety, sounds about right. What's going to happen? Interest rates are moving. 2024, are we getting to hope? I think so. And hopefully we're at relief and on the way up in 2025. Who thinks that we're going to do better in 2025 than 2024? Okay, I'm going to raise my hand. My previous comment, if you're not feeling positive in the first quarter, you need to go see somebody. That's the only reason my hand's up. So I feel like things are getting better. It's just going to be slow. And primarily due to interest rates. It's just the tail that wags the dog and drives everything. Market predictions. I think we'll have better leasing velocity this year. Public Storage on their call today said things are getting a little bit better. I think there's a lot of this pent-up demand of these people between 25 and 44 that have to move. They have 3 kids in a 2-bedroom house, and something's got to give. I think that part, I just feel like that's going to change. 58% of people moving indicated they will use storage. There's still a lot of discounting going on. So, like the new one that I opened, we discounted rents by 80%, and we filled up in 4 months. So, a cheap unit can capture demand. It won't create demand, but it will sure capture it. Capital markets, stability. I hope so. The last year was very choppy, so we can have some stability. Buyers can get deals done. It's just a matter of pricing, and pricing is depending upon how much the capital is, and they know what that is every single day. So, optimistic for improving operating fundamentals, and I think storage loans will continue to be coveted. You could raise rents monthly if you want to, so it's a great inflation-adjusted bond in a way, and a very diversified tenant base. Valuation will improve as the lending markets and market fundamentals improve. I believe that. Cap rates remain flat. That sounds about right. I think we'll have some remorseful non-sellers who wish they would have sold in 2021, and they just realized the vote's not coming. I met with a REIT 2 weeks ago. We looked at this guy's property. It was off market, and the REIT offered him $12 million in 2022, and he's getting 86 cents a foot, and he needs to get to $1.10 a foot to get his number. And so if he grew rent 5% every year, it'd take him until 2033 to get that done. So he just hasn't arrived at acceptance of kind of where things are. Development wave will continue being slow. And what else? We have positive. Real estate cycles always last longer, go farther. That's true. Economy stronger, interest rates. That's the tail that wags the dog. We see a big price discovery. We see 20 to 30% in bid sheets on deals that we sell. It's not uncommon. Sold a deal in Georgia 2 years ago. The low bid was $6 million, the high bid was $12 million. And everywhere in between. It's just commonplace. The Fed is still a wild card. They are in the longer end of the curve. All right. Do we have questions? Yes, sir.
Yeah, Jared, how do these things rehab?
How
If
do
I,
they-
if I find some dude that's had it for 20 years and everything's rusty, how big a deal is it to come in and clean it up?
Ooh, it depends on the scope. I mean, if it has a bad roof, you know, it's going to be very expensive to do that. Doors, probably running around $700 to $800 a replacement, you know, of the doors. I mean, I've done rehabs myself on storage, and the first one I had, we had to put 7 new roofs on, and there were 9 total buildings. And so that rehab was probably at least $10 a foot.
So doors, the overhead doors are a big factor.
Roll of doors and the roofs are the biggest factors. Yeah.
Okay.
Yes, sir.
I have a quick question on the outdoor side. Do you
Okay.
deal only with the indoor climate controlled stuff? How much demand is there for just like RV boat storage and lots?
Yeah, that's a good question. I think that, you know, during COVID, nobody could find a boat, nobody could find an RV, right? And there's 10,000 people turning 65 every day. And that was a leading indicator, and a lot of people built a lot of boat and RV. I think that we've overbuilt that, to be candid with you. And I think it's a good product type, but the way that I learned the business is the underlying value of real estate is always going to be the rent. And so on boat and RV, it's less efficient because you have 40 to 50 foot driveways to be able to turn those things. And the price per square foot, like anything else, just skews downward. And you have to build a taller building as well. So I think it makes sense in the right areas. But to give you an example, that facility I was showing you that I just developed, I'm going to add a 5,000 square foot building behind it. I was looking at doing, you know, maybe some boat and RV or regular mini storage. But, you know, boat and RV, I didn't think I could find anybody who would rent a boat or an RV unit for $1,000 a month, right? But that would be equal to the rent that I would need to get to rent somebody a 10 by 10 for $200 a month. Does that make sense? So the rent per foot is higher on like climate and smaller units, but you don't want to build too many, you know, 5x5s or smaller stuff.
Where I was going with that is that I knew somebody who offset. He built a small amount of the climate controlled and indoor stuff, and then he basically just had open lots on the dirt. So it was very cheap for him to develop the dirt, and he packed it essentially. So I was just curious if that was a big factor or not really.
It's a good way to land bank that additional land, maybe for a future phase. You do have to pay sales tax on, you know, different things that you do store in open parking. Some cities will, if you're going to do that, will make you put down concrete at $7 a foot, which makes that number a little bit hard. So I think it depends on where it's located and how difficult the municipality is and what they're going to require to be able to do that. Okay. Anybody else? Yes, sir.
Can you talk more about the CMBS loan? Like what's the benefit of that, and why would you see that over the other loans that you talked about?
Yeah, great question. His question was about CMBS, which stands for Commercial Mortgage-Backed Securities, and why would somebody do that versus getting a loan with like MidFirst or something like that? Basically, maybe 3 reasons. Typically, you can go on a loan program like that, it'll be lower leverage, probably 50 or 60% or lower, and probably a minimum of at least $3 to $5 million. So the benefits of that is you can typically get non-recourse, which means you're not personally, you know, responsible. Typically, you can get a longer amortization, a 30-year amortization versus a 20 or 15, or even interest only for 10 years. So a lot of low leverage deals, people will do that, those types of loan programs. Yes, sir?
Why would you recommend storage over other commercial investment vehicles, and why wouldn't from commercial real estate versus multifamily?
Yeah, good question. Why would I would recommend it because your tenant base is very diversified. If you say you had a 20 unit complex and you lose 2 people, you lost 10% of your rent roll. If you had a 500 unit facility you'd have to lose 50. So your bad days aren't quite as bad once they're stabilized. You also have no toilets. You don't have any sheetrock. You have no leasing commissions. It's lower maintenance. You can also raise rents on a monthly basis if you wanted to, if inflation is really out of whack. The reason it may not be quite as good, your cash flow is not as predictable, right? If you had a 10-year lease like I have Starbucks, I know what they're going to pay me, right? And then also you can get into a little bit of psychology, right? Anybody heard of Maslow's hierarchy of needs? What's going to get paid last? The cell phone bill, the Netflix bill, the apartment rent, or the storage rent? Probably going to be the storage rent, right? So from a primary, secondary, tertiary need perspective, that's where I think the gap is compared to like housing and some other things like that.
Do you have to do a lot of collections?
It depends on the property. We have a very good lien law process that through the Oklahoma Self-Storage Association we've modified, but it's not storage wars. You're lucky to get 10 cents on the dollar. So in 13 years, I've only had 3 units that have ever sold for equal to or more than what they owed me. And I think in every case, that person was in jail and it was stolen stuff. So typically, you just want the space back so you can re-rent it to somebody else. There's not gold in those units. Anybody else? Yes, sir.
If somebody was looking to get into storage units in this, let's say in this room, they might have 100 or 200,000 to put towards that. I mean, that's probably a pretty small complex. Are we bidding up against some of these larger institutions? And can you give us any advice when we're looking into that, not knowing a ton? What are the top two or three things that you'd be looking at?
Yeah, you're not going to be competing against any institutions. There's 4 types of buyers. And a typical institutional buyer, they need to have a minimum gross revenue or the ability to get there of about $500,000 in just top line. And the reason is that's where the offsite management fee scales. Because if you were to hire a third-party manager, they would charge you the greater of $2,500 a month or 6% of your revenue. And so at $30,000, that's when that scales. So how would you get started? I mean, it's kind of tough because I have this conversation with a lot of different people. Say that you buy a $500,000 facility, right? And we'll say that the cap rate is, we'll say at 9%. So that you're making $45,000 a year, okay, before debt service. And you're going to borrow $400,000 just to be able to get there. And we'll just make the math easy. So you're going to borrow $400,000. We're going to say your interest only and your interest rate is 7%. That's $28,000. So 45 minus 28 is $17,000. Who's going to borrow $400,000 to make $17,000? Any takers? That's where it gets tough. Is because it kind of turns into a job for you, right? And the margins may not be big enough. So sometimes I do see people get into too small of a project and the cash flow just isn't there. So you really have to buy it, right? Or maybe build it and just gradually go.
Is there an advantage or a particular opportunity right now to build instead of buying them?
If you can find some cheap land, maybe you do like some container storage, maybe throw down some gravel and you do it that way. Now it gets harder and harder in municipalities because what they say is, Jared, you're going to employ 1.5 people, you're going to take 3 acres, 5 acres, and you're not going to pay sales tax. What's in it for us? They just do not, a lot of cities just do not like storage. They don't look at it in terms of, well, if we had storage, then maybe this housing community, instead of being 2,000 square feet, maybe it could be 1,800 square feet. And then you could get more housing in the lots and make it more efficient, right? So I think it's short-sighted, but obviously I'm biased. Any other questions? Thank you, guys.